Hi, thanks so much for joining in. You're watching NDTV Profit and my name is Alex Matthew. This is a special program, Building Bharat's Wealth Mindfully. The mutual fund industry and mutual fund investing in India has come of age. And there are a few factors that have contributed to this. A smart campaign by the industry, a great outcome for people who got in during COVID-19 lows, and the continued surge in new investors making their way towards mutual funds. That number currently stands at 6 lakh per month. But the challenge is for these new investors to make the right decisions. And that's understandable because of the sheer number of offerings in the market. As of the end of 2025, there were over 500 actively managed equity mutual fund schemes. And throw another 178 hybrid funds into the mix. And the question is, how do you choose the right scheme for you? That's what businesses like Share.Market PhonePe Wealth are building for. And to talk about that and the challenges that it entails and the opportunities therein, I'm joined today by Ujjwal Jain, who's the Chief Executive Officer, and Nilesh D Naik, who's the Head of Investment Products. Gentlemen, thanks so much for taking the time. It's an exciting time for all of us watching this industry grow, right? If you look at it a decade back, you look at the numbers right now, it's staggering. Seemingly, as you're looking at it on an ongoing basis, it's not as staggering as if you look at it 10 years back. But in your life cycle as well, what is the kind of experience that you're having onboarding clients right now? Is it as frenetic the activity as you saw soon after COVID?
SIP growth has started was going very healthy pre-COVID also. Post-COVID, actually, it made a more like a population scale shift. And when I say population scale shift, the whole, there was a change in terms of how people actually look at their wealth creation. And for the most part, actually, if you look at population scale, right? And when I say population scale, it's across the length and breadth of the country. Majority of the people cared about wealth creation through traditional assets and largely fixed deposits, which is looked with a lot of safety, gold, possibly residential real estate for most of the middle class end users. But it is only post-COVID people have started making that shift from traditional wealth creation instrument to financial instruments.
Right.
And there, mutual fund came as a very, very important instrument, thanks to the Mutual Fund Sahi Hai campaign also, which has helped build a lot of trust in the industry and the people to actually get into markets through mutual funds. But a few other things that have also transformed the way people look at markets. Some of them is like the entire inflation, right? The real returns for that matter. When look at FD returns, people realize that post-tax, the income they make on FDs, actually the real returns are not, can't compete with, like can't actually help for adjusting for inflation. So that is where people started actually realizing that I can embrace equities market, especially mutual fund, which is more stable and managed by fund managers, and take a long-term view and use that volatility of market as with a lot of patience, especially through SIPs, and go on investing in that, invest in that and actually make a long-term, make better returns than fixed deposits. The other is the UPI, the Unified Payment Interface. What that has done in India is that when you get into mutual funds, you have to do Aadhaar-based onboarding. So the India stack has worked tremendously well for people to simply go online and open their mutual fund account. And with UPI, the trust rub-off to actually use payment as an instrument to set up SIPs, that has worked really well. So these things collectively has actually helped people to shift to financial assets, especially mutual funds. And that growth we are seeing even today. And that is now stabilized.
So just to drive home that point, Ujjwal, would you say that now the challenge, not just from the perspective of the investor, but also from the perspective of the platform or the service provider, is no longer access? It is something that practically everyone has the ability to do. It's not challenging to get more people to come and invest. Is that fair?
Yeah, actually on the access, there's still a lot of opportunity to make sure mutual fund is out there available to most. at a lower entry barrier. So reducing the entry barrier is actually one part of the problem. On the excess, that is still a big market opportunity for people to actually embrace mutual funds. But a larger problem statement is that, okay, I have access to mutual funds, as you started the show with that number of schemes that we have in India. What is the right mutual fund to get into? So when you're starting with a mutual fund investment, you cannot go with a trend-based mutual fund or a random mutual fund without any thinking. That could actually be you will start on a very bad note. Sure. So that is where, how do you make sure that you invest in the right mutual fund? So as a platform provider, we look at this as a very massive opportunity as a business also, but from a consumer point of view, that's a real opportunity to make sure that the customer come on your platform, not just get access, but also get right information and knowledge to invest in the right mutual fund and build a long-term wealth with a 10, 20, 30-year view.
Okay, so I want to bring you into this conversation because we've been talking about, I know that I have been at least from 2016 onwards talking about making the right selection of funds. The tendency is that you will select something and you will go back 3 years later and say, oh no, I made a horrible choice. Do you see that taking place even today despite the proliferation of information that is available?
Yeah, I think largely we still see that trend, and in fact you are right. If you look at numbers, right, we actually have done this study in terms of looking at what is the correlation between let's say previous 3-year return versus next 3-year return, and invariably irrespective of the category that you choose, you will realize that that correlation is close to zero, which means the past performance doesn't tell you much about what you can expect, right? But unfortunately, I think a lot of investors invest based on the past returns, and which is where, like Ujjwal mentioned, the investment decision making, choosing the right product is very, very important, so that from a medium to long term perspective, investor have a decent experience of investing into mutual funds.
The challenge though is always when an advisory comes into play or even a distributor comes into play, there is a one-on-one. But traditionally platforms have been used to have a low-cost model and to have an execution-based model. People take ideas from elsewhere and they execute. They look at it not from the perspective of I'm getting advice on this platform. But you guys are playing this differently. Can you explain how that works?
I think, Alex, when you look at investing, one thing is to say that, okay, this is the best product to invest in, or this is the right time to enter or exit the market. But I think what is also important, and I think more important, is that you avoid making big mistakes. If you avoid big mistakes, then you are more or less set to achieve your financial goals and create wealth, provided you are disciplined enough. And I think for platforms, that should, I think, going forward be the focus as to how you help investors avoid those big mistakes and how you help them to be more disciplined. So in our case, for example, we very early realized that a lot of investors are investing purely based on performance, which means if you have to sort of accentuate that behavior, you just show funds based on returns and people will invest.
Oh, you have a star rating.
You have a star rating
that is based on past returns.
Correct. And even the returns number, which are very easy to understand, right? But intentionally what we have tried to do is that stick to core products. For example, categories like flexi cap, large and mid cap, value. These are typically good categories for any investor with a long-term horizon to start their, let's say, SIP. And more importantly, when investors are investing, we have been heavily focusing on SIPs because that takes away the timing risk to a large extent, right? The other point that I wanted to mention is, we have launched a very interesting tool called CRISP.
CRISP. This is an acronym. I'm sure this is an acronym because otherwise it sounds like something that I would bite onto.
Yeah, yes, it is. So CRISP actually, Alex, stands for consistency, risk, and investment style of portfolio. So a lot of people invest based on past returns like we discussed, but not many people look at, let's say, consistency of performance in terms of rolling returns, etc. So we take that into account. We look at the risk in terms of, let's say, standard deviation of funds and compare it with the peer group and so on. And most importantly, we also look at the investment style of the portfolio. You often hear experts talking about, how investors should know, how the portfolio is managed. But the retail investors have no clue what that means, and which is where the style of the portfolio is very critical. And I think
so. When you say style, let's drive home this point, and you can weigh in as well, Ujjwal, because and we speak about it on an ongoing basis. Not everyone understands it, as you pointed out. So when you say style, you're talking about the overarching style of either the fund house or the fund manager to say that they're constructing their portfolio either from the perspective of a value bent, or they will have a momentum bent, or they will have a growth and quality bent, or they will have a low volatility bent. That's what you mean by style, right?
Correct. So each fund manager will have his or her own style for that particular fund. It can be a mix of styles as well,
sure,
right?
Yeah.
But when you have perspective on the style of the fund, it makes it relatively easy for you to construct a portfolio which is well diversified across styles. And that's very, very important concept, when it comes to investing, the diversification part. It's not just across stocks and sectors.
Extremely important that you're pointing this out, because if you look at the last 10 years, data will tell you that a value style has outperformed 7 years out of 10. It will tell you that a quality style is outperformed in less number of years. So it depends at what point in the cycle did you invest. If you invested in those 3 years when value underperformed, then you will hate the scheme selection that you've had, but you're playing it differently. Is that how it works?
Yeah, so what we are trying to make sure is that we take the last 5 years of data and individual fund houses, individual schemes, underlying holdings. So entire proprietary model, which is the CRISP model, has been built using that data and help you take a forward-looking view on basis the rolling characteristics across this performance, rolling performance, risk, where you are versus your on the risk side with your peer group within the scheme category, and also on the style. So what it helps is that if you realize that some managers have done really well on performance, but their style does not show any characteristic, which means that they've made like choices in the underlying portfolio which are not characteristic to their actually scheme ethos, that all comes out well. Now, but the challenge actually, as Nilesh pointed out, these things appear to be very complex when you look it from a consumer point of view, and especially when we are working to make sure that the Bharat adopts this model when they get into mutual funds. The opportunity is that the access, when we talk about mutual fund, the experience to provide the access, most of the platforms have done really well, including us. Now, when it comes to decision making, so part of the problem is that how do you build your underlying technology, research platforms to actually able to analyze these mutual funds on an ongoing basis, and on the consumer side, how do you make these information and knowledge packed in a very simple, intuitively well understood form?
And Ujjwal, this is fascinating. So I'm sure that when you're building out these products, and ultimately these are tech offerings where you're trying to understand how somebody would behave in a certain situation. So I'm sure that conversations with your developers will be along those lines, where you're saying that you're designing the UI of that application to say that if I showcase this kind of data, if I have this prompt when I make a selection, then the tendency of the user is going to be 9 out of 10 times they will either sell or buy. Is that the kind of conversation that you do?
Take the example what Nilesh pointed about. Now, a lot of people say that people end up buying a lot of mutual funds basis the past return, and a lot of recency bias in that. A part of the problem is because of the user experience design also of the WealthTech platforms, where they actually end up showing on their landing pages a lot of mutual funds with trending past returns, right? So anybody who is getting into mutual fund will tend to get captured in that user experience far more because they are starting first time.
And it's FOMO.
Yeah, right. Now imagine you build a user experience with that mindset that how do I put all that research that I've done through CRISP in user experience form factors, so that when people get into these mutual funds, they have the right information, and you are basically, by the time you make a mutual fund selection, maybe today 2 out of 8 are trying to be experimenting by getting into wrong mutual fund. Maybe 6 out of 8 would now eventually be in a better position to start with a right flexi cap or a large cap or a more diversified mutual fund. So I think part of the problem is to get the research right and globally best, like comparable research, make that available to Bharat, and use the user experience design as a consumer tech company to make that accessible to consumers and make sure they adopt in the right way.
So couple of things that stand out, and Nilesh, maybe you'll be able to weigh in on this on behavior, right? Which is that so many studies have pointed out that individuals make less returns than the schemes that they invest in. And just to drive home that point, as an example, suppose I'm investing in one mutual fund scheme, just one, and that scheme has given me a return of, say, 100% over the course of 5 years. I may have experienced an 80% return, and the reason is that I might have stopped it at certain moments.
Correct.
I might have pulled out at certain moments. I might have worried about the equity markets falling by 20% and then stopped an SIP at that moment. So what is that kind of behavior nudge that you're providing? Because ultimately stickiness is almost always the most important thing when you're building wealth over the long term.
Correct. Alex, I think, there is this interesting quote by Benjamin Graham, the investment guru, right? He says the investor's chief problem and even his worst enemy is likely to be himself.
Yeah.
Right. And when you look at, the behavior of the investors on ground, you realize how true that statement is. So for example, you mentioned about funds returns being better than the return that the investor make. I'll give you one recent example from, our market itself, right? Just go back about 1.5 years, June, July of 2024, when market was really doing well. You just look at the equity flows, right? It was roughly about 81,000 crores. And if you look at, let's say, Feb, March 2025, by when, the market had corrected almost, I think, 12-15%, the flows came down to about 56,000 crore. And that's not the
You're
entire
saying gross flows.
Gross inflows into equities. And that's not the entire story, because there's also a SIP component to it, right? And if you adjust for SIP component, it's like 60,000 crores versus 30,000 crores. So there's a 50% drop when the market has corrected by 12-15%. And when you have people investing more at market peak and in investing lesser amount at when the market corrects, that's the reason for this kind of behavior. Now there's a big opportunity, I think, across board, not just the digital platforms, but I think that's the most important value add that an intermediary can do, be it a MFD or a RIA, right, to the investor's life. So how do you nudge people to continue their SIPs during those times? How do you get people to invest more when the market's correct? And those are the things, I think, which are very, very critical in terms of solving for investors' problem.
So I think this is important, and I'm asking from the perspective of business, right? Ultimately, you're talking about it. What should ideally be the behavior? From your perspective, it's good if they follow the right kind of behavior, because the outcomes that they will get over a slightly longer time frame would be better than a peer group that might make the wrong choices. Initially, they might see a spurt or they might not, but eventually it will fall off, right?
Yes.
So is that the model that you're trying to follow, to say, okay, I want to get maybe not the best returns in the industry, good returns that people can bank on so that they can have financial success?
Correct. I mean, so look at it, the money from where the opportunity cost of that money coming from. It's coming from fixed deposits,
Fixed deposits,
right?
yeah.
So the expectation is to make incremental return. Now the fact is, on the extreme end, equities market are sold with very high returns expectation without looking at the risk part of it. So the idea is that if you can balance the risk well and get a consistently better returns year over year, then as a platform, we have actually able to champion our cause of making sure that you get into a right mutual fund.
And just to add to what Ujjwal mentioned, right, see, mutual fund is not about just acquisition. Or let's say if you look at the last 6 years, 2019 end, we were close to, I think, 1.9 crore unique investors in the industry. Today, we are close to 6 crores. And the run rate is almost similar, even as we speak. But the most important part is to retain those customers, ensure that they have right kind of experience. Because whether you are talking about the intermediary like us or whether you are talking about the investor, I think it works very well when people stick to the product and invest with a long-term perspective. And that's where I think it's very, very important to do right kind of, offering right kind of products to the investors.
Yeah, I mean, I think that point is driven home by the SIP figures, right? You have a 31,000 crore gross number, but everybody in the industry agrees that that net number is significantly lower. 35% is what is expected to be the number. And that's because there is pausing and switching of SIPs. You're doing a daily SIP as well.
Yes.
Are you finding traction in that?
Yes, we are finding traction in that, and I think part of the problem was that people with investable savings slightly lower, and as you expand the reach of markets, how do you make sure that even the people with very on the lower income households level can start at a very small amount and build that disciplined habit of SIP, which continue to extend from what monthly SIPs have given. We have launched a daily SIP with rupees 10 as a start.
Okay, very interesting. Just a last thought, Ujjwal, and we're closing out the program, but I wanted to get your perspective on the kind of demographics that you've seen, particularly over the last 1 year, in a time when the equity markets have not been absolutely fantastic. Are you seeing encouraging signs from tier 2, tier 3?
Yeah, I mean, 70% of our AUM, fresh money that comes on our platform is coming from B30 and beyond cities. And I think, and that is where we have realized that majority of people to actually appreciate equity as an instrument for wealth creation and using mutual fund as an instrument, that I think irrespective of the market cycles, things are stabilizing. That is the factor of stabilizing. While still there are redemptions during a down market, but versus past, we are shifting the base as a country, right? And you can see that even as we speak, right? FII outflows continues, right? Month on month, right? Still, Indian markets able to absorb that with domestic money, and that is fully driven by retail money, which is actually represented by larger Indian society, right? And I think we are now becoming the strong hand here.
Yep, the base is shifting.
Yes.
On that note, gentlemen, thanks so much for taking the time. Well, you heard it. The base is shifting. And what a message to end this program on. Thanks so much for tuning in. This is NDTV Profit.